So today we're digging into what on earth happened at Genuine Parts Company. It was a day with a huge, exciting announcement that got completely steamrolled by a brutal reaction from the market. Let's get right into it.
And boom, here's the verdict from Wall Street, and it was swift, a drop of nearly 15% in one single day. That is a massive hit for a company this size, and our job is to figure out exactly why it happened.
And this is the central mystery, right? GPC comes out with this huge plan to split the company in two, something that investors usually love. I mean, theoretically, this should have been great news. But instead, the stock just fell off a cliff. So what gives? That contradiction is what we're going to unpack right now.
Here's our game plan. First, we'll look at the two competing stories the market was hearing. Then, we're going to pull out the report card for their fourth quarter. After that, we'll dive into that big breakup plan and then pinpoint the real problem child, the guidance. And finally, I'll give you our official take on what to expect next.
Okay, so what we've got here is a real classic Wall Street dilemma. On the same day, GPC basically told investors two completely different stories. And investors had to decide right then and there which one they believed more, the promise of a better future or the pain of what's happening right now. So, in one corner, you've got this really compelling long-term plan, a big strategic split by 2027 to create two laser-focused companies. That's the kind of thing that gets strategists excited. But in the other corner, you have the cold, hard reality. They missed their Q4 earnings, and their forecast for 2026 was, well, pretty weak. The market had to choose, and it looks like the short-term pain won out. Big time. All right, let's pop the hood and get into the actual numbers, because the Q4 report card is really where this whole negative story started, and it absolutely set the tone for the rest of the day.
And this table just lays it all out. The adjusted earnings per share, or EPS, came in at $1.55. The street was looking for something closer to $1.82. That is a huge miss. We're talking 15% off the mark. Revenue also came in a little light. These were the first major red flags the traders saw, and it set off alarm bells everywhere.
Now you might see this massive, scary-looking GAAP loss, a negative $4.39 a share. And then you see this adjusted number, a positive $1.55. You're probably thinking, what's the deal? Well, the difference comes down to one really big, one-time accounting item. And here's the thing that caused it, a massive $825 million non-cash charge to settle their pension plan. Think of it like a big accounting cleanup. It's not cash going out the door, and it doesn't reflect how the business is actually performing day to day. That's why analysts always pull it out to get to that adjusted EPS number. It's important to know, but it definitely didn't change the fact that they missed on the number everyone really cares about.
So, the quarter was rough, no doubt about it. But that was just one half of the announcement. Now let's pivot to the really big, forward-looking plan that management was hoping would be the headline.
The plan itself is pretty ambitious. By 2027, the GPC we know today will be gone. It's going to split into two separate, publicly traded companies. One will be for its crown jewel, the global automotive business, NAPA, and the other will be for its global industrial side, which is Motion. The goal here is to create two pure-play giants, each dominating its own field.
And here's the official rationale, straight from the CEO, Will Stingel. He's talking about unlocking potential and maximizing shareholder value. And the logic makes sense. Each business can have its own strategy, its own budget, and tell its own clearer story to investors. It's a classic corporate strategy.
Okay, so we've got a weak quarter, but a really bold long-term plan. So it still doesn't quite add up, does it? Why the massive sell-off? Well, it all comes down to the guidance, the forecast. This is where things really went south.
And this right here is so important to understand. For an investor, a promise for what might happen in 2027 is nice, but what really matters is what's happening next year. And when investors looked past the breakup plan and focused on the 2026 forecast, they did not like what they saw. And this chart, wow, this chart tells the whole story. Look at this. The company ended 2025 with about $7.37 in adjusted earnings. Now look at what they're guiding for in 2026, just $7.75 at the midpoint. We're talking about maybe 5% earnings growth. That is a serious slowdown, and it's just not what the market was pricing in at all. This was the dagger. All right, so that's the breakdown of what happened and why. Now for the part you've been waiting for. Let's pull this all together and talk about what we think happens next. Here's our official take. So when the next earnings call rolls around, here are the 4 things we are going to be laser focused on. Number 1,
Can they get their profit margin stabilized in the auto business? Number 2, we need more details on this breakup. Timelines, costs, milestones. Number 3, they blamed part of the miss on weaker sales from independent owners. We need to see that turnaround. And finally, Europe was a weak spot. Any sign of life over there would be a big, big positive.
So, putting it all together, here is our official call. For the next quarter, we think the pressure is going to continue, but the market's going to be hunting for any little sign of stabilization. Because of that, we see the stock price staying stuck in a range for a while, at least until a clear positive catalyst shows up. And that leads us to our official rating, market perform. The long-term breakup story is interesting for sure, but the near-term execution risks, they're just too big to ignore right now.
And as always, just the final reminder for everyone, this is not financial advice.